Illustration 2, a question relating to the consolidated statement of financial position. This question discusses all the necessary consolidation adjustment with regard to a basic group structure. Basic group structure means parent is having in this question a subsidiary and associate, right? So let's read the question. 1st January 2020, Paladin secured majority equity shareholding in Saracen on following terms. An immediate payment of 4 rupees per share on 1st January 2020 and further amount deferred until 1st January 2021 of 5.4 million. So there's an immediate cash payment, 4 rupees per share, and also a deferred consideration of 5.4 million that has to be paid from the acquisition date in 1 year's time. Immediate payment has been recorded in the Paladin's financial statement, but the deferred payment has not been recorded. Paladin's cost of capital is 8% per annum. So here only the immediate cash payment is recorded. Deferred consideration is not recorded. That means we have to record the double entry. Okay, if there's any unrecorded transaction, we have to record the debit entry as well as the credit entry both. Then 1st May 2020, that is during the year, Paladin also acquired 25% equity shares of Augusta, paying rupees 10 million in cash. So Paladin also acquired 25% investment in Augusta. This is actually a associate, right? So normally having 20% to 50% investment in another investee gives the significant influence over that investee. So that has to be considered as an associate. So the equity accounting is the accounting treatment to be followed. Then summarize statement of financial position of 3 companies at 31st December 2020 are. You have been given the financial statements of the parent company, that is Paladin. Then Saracen is actually the subsidiary, right? And Augusta is the associate. So the year end is 31st December 2020. So if you read the question, all figures are given in thousands, right? Non-current assets, property, plant and equipment, thereafter intangible assets, investment made by Paladin in Saracen and Augusta. So as per the question, when it comes to the investment in subsidiary, investment in Saracen, only the immediate cash payment have been recorded. So parent acquired 8 million shares. Per share, parent has paid 4 rupees. So now if you look at the number of shares that the subsidiary has, altogether how many shares? Equity capital of the subsidiary 10,000. 1 rupee each is the nominal value, which means 10,000 shares. Out of these 10,000 shares, how many shares have been acquired by the parent company? 8,000 shares. In millions, 8 million shares. Okay, so which means 8 million shares out of 10 million, or 8,000 shares out of 10,000 if it is taken in thousands, which means parent has acquired actually 80% investment of the subsidiary. So which means 20% holding of the subsidiary is held by the non-controlling interest. In addition to that, in this question it's mentioned consideration is paid in 2 forms, immediate cash payment and the deferred consideration, but what is recorded? This 32,000 is the immediate cash payment only. Deferred consideration is not recorded. We have to record that once we answer to the question. Then investment in Augusta 10,000. Okay. Then moving to the current assets, inventory, trade receivable, bank. You have been given the numbers with regard to the current assets. Total asset value is given. After that, equity and liabilities. Under that equity shares of the 3 companies. So the nominal value is 1 rupee per share. Then the retained earnings balance at 1st January 2020, that is at the beginning of the period, right? And the retained earning increase for the year ended 31st December 2020, that would be the profit made for the year ended 31st December 2020, right? So now if you want to take the closing retained earnings, what you can do is opening retained earnings plus during the year profit will give you the closing retained earnings of each company. Then the total equity value is given. Moving to the liabilities, non-current liabilities, there's one non-current liability, that is deferred tax liability. Then current tax liabilities, under that we have bank overdraft and trade payable. So then the value of the current liabilities, total value of the current liabilities are given, and finally total equity and the liability figure. Then following information is relevant. So these are the notes, or else these are the adjustments that we need to make at consolidated financial statements. Let's take one by one. First one, Paladine's policy to value non-controlling interest at fair value at the date of acquisition. For this purpose, directors of Paladine considered share price of Saracen of ₹3.50 per share to be appropriate. So the non-controlling interest is measured by using the fair value method. Okay. We discussed there are two methods to measure the non-controlling interest: proportionate net asset method and the fair value method. In this particular question, NCI is measured by using the fair value method, and you have been given the information to calculate the fair value of non-controlling interest. At the date of acquisition, this is the second adjustment. At the date of acquisition, fair value of Saracen's property, plant and equipment was equal to the carrying amount, with the exception of Saracen's plant, which had a fair value of 4 million above its carrying amount. You know, when parent acquires subsidiary for the consolidation purpose, we need to fair value the identifiable assets and the liabilities of the subsidiary. Here, with regard to a particular asset, plant, right? So the fair value is higher than the carrying value by 4 million rupees. That has to be factored as a consolidation adjustment. Moving on, at that date, plant had a remaining life of 4 years. So the remaining useful life of the plant is 4 years. Saracen uses rate line depreciation for the plant, assuming no or nil residual value. So the remaining useful life of the plant is 4 years, and the method of depreciation is rate line method, assuming no residual value. Then also at the date of acquisition, Paladine valued Saracen's customer relationship as a customer-based intangible asset at a fair value of 3 million rupees. Saracen has not accounted for this asset. Trading relationship with Saracen's customers last on average 6 years. Now there is a, I would say, intangible asset. So there's an internally generated intangible asset that the subsidiary has. So in the books of the subsidiary, this is not recorded. That is correct. As per LKS 38 intangible assets standard, you can't recognize the internally generated intangible assets. Now the question is, when Paladine is preparing the consolidated financial statements, so this is actually this is not a, now if you take it from the parent's point of view, for the parent this is not an internally generated intangible asset, right? So what we'll do is, when preparing the consolidated financial statements, if there are any intangible assets, if the subsidiary has not recognized at the consolidation level, we may need to recognize, we need to look at that. Okay, so we'll discuss that once we answer the question in detail. Then the adjustment number 3, 31st December 2020, Saracen's and Augusta's inventory included goods bought from Paladine. This is the cost to the Saracen and Augusta of 2.6 million rupees and 3.9 million rupees respectively. Paladine had marked up these goods by 30% on cost. So it's an intercompany sale, and this is actually an unrealized profit adjustment. So during the year, parent sold goods to the subsidiary and associate. Some of the inventory items are still held by the subsidiary and associate, right? We need to look at how to make the adjustment. Adjustment number 4. Paladine's current account balance with Saracen at 31st December 2020 was 2.2 million rupees, which did not agree with Saracen's equivalent payable due to a payment of 0.9 million rupees made by Saracen on 28th December 2020, which was received by the Paladine and which was not received by Paladine until 3rd January 2021. Now, subsidiary has made a payment before the year end, but it has not been received up until the year end by the parent company. It has been received after the year end. So because of that, there's a mismatch between the two companies' current accounts. So this is actually the intercompany balances. We know at the consolidated financial statement level, intercompany transactions and the intercompany balances are to be eliminated. right? But before elimination, you have to make sure that the balances are tallied, right? So it seems that because of this particular payment, the balances are not tallied. What are we going to do? We'll discuss. Then Paladine's agreed current account balance owed by Augusta at 31st December 2020 was 1.8 million rupees. So with the associate, Paladine is having a current account balance. This is matched with each other. Okay, what are we going to do for that? Let's look at adjustment number 5. Paladine transferred an item of plant to Saracen for 2.5 million rupees, which had a net book value of 2 million at 1st January 2020. Remaining useful life of the plant at the date of the transfer was 5 years. Now there's another intercompany transaction. Parent has transferred one of its plant to the subsidiary with a profit, right? So this is yet again a situation of an unrealized profit if you look at the group perspective, right? And here the unrealized profit adjustment is little complicated because in addition to the unrealized profit, there is an impact of depreciation as well. We'll look at how to do the adjustment. Adjustment number 6. Impairment tests were carried out on 31st December 2020, which concluded that consolidated goodwill was impaired by 3 million rupees, and due to disappointing earnings, value of the investment in Augusta was impaired by 2.5 million rupees. Okay, so goodwill is impaired as well as investment in associate is also impaired. Finally, adjustment number 7, assume all profits accrue evenly throughout the year. So especially associate was acquired at the during the year, so you have to time apportion the profit when you are taking into the calculations. What is required? Prepare the consolidated statement of financial position for Paladine as at 31st December 2020. Reporting date is 31st December 2020. Right. So now we read the question. Then talking about the way that you need to answer, what you need to do is, first of all, you need to have the space for the statement of financial position, Paladine Group, consolidated statement of financial position as at 31st December 2020, right? Then you have non-current assets, right? Current assets, equity, non-current liabilities and current liabilities. You need to keep the space for the preparation of consolidated statement of financial position. Then what we need to have is, for any statement of financial position question in relation to consolidation, you need to have 5 mandatory workings, right? What these 5 mandatory workings are: working number 1 would be the group structure, working number 2 would be the net asset table of the subsidiary. For each subsidiary that we have, we need to have a net asset table. In this case, you just have only one subsidiary, so one net asset table. This net asset table should reflect us the net asset value of the subsidiary at the date of acquisition, at the reporting date, and post acquisition. Post acquisition means the gap between the acquisition date and the reporting date, or the change from the acquisition date to the reporting date. Then working number 3 should be the goodwill calculation of the subsidiary. Working number 4, non-controlling interest. And working number 5 would be the consolidated retained earnings, parents' retained earnings. So these are the 5 mandatory workings that you need to have in any consolidated statement of financial position question. In addition to that, in this question, you have an associate as well, right? You have an associate as well. When you have an associate, what you do is you do an additional working for that to find out the equity accounted value of this associate in the consolidated statement of financial position. That would be my working number 6 in this question, investment in associate. Then depending on the requirement, you may need to do the additional workings. Okay, right. Then let's start from the group structure. We need to understand what is the relationship between the companies. Now, if you look at the question at the very beginning, it was mentioned 1st January 2020, Paladine secured majority equity shareholding of Saracen. Now, we looked at when we were reading the question, so Saracen is having 10 million shares, or in thousands, 10,000 shares. Out of that, parent company has acquired 8 million shares, or in thousands, 8,000 shares. So which means Paladin has acquired 80% of the equity shares of Saracen on when? 1st January 2020. So this is the first information that I need to have under the group structure. Go to the group structure and say that P acquired 80% of equity shares of S on 1st January 2020. So that means parent can, or the Paladin can consolidate S Saracen from 1st January 2020. So basically here I am preparing the consolidated statement of financial position. So that is prepared at the reporting date 31st December 2020. What we look at is at 31st December 2020 whether S is considered to be a subsidiary. Yes, it is considered to be a subsidiary because parent has the control over the subsidiary, right? You can, or the parent company can consolidate the subsidiaries numbers, right, and prepare the consolidated statement of financial position. Then the next information is about the associate. According to the question, on 1st May 2020, Paladin acquired 25% of equity shareholding of Augusta, right? So the next information is P acquired 25% of equity shares of A on 1st May 2020, right? So this is what we need to do, what we need to have under the group structure. Then I understand the relationship between the group companies. As at the reporting date 31st December 2020, Saracen is a subsidiary, Augusta is an associate. Now if I ask you how many group companies are there? So remember, group includes parent plus subsidiary, right? So number of group companies are 2. You have to consolidate only the subsidiary, you don't consolidate the associate. Associate is a special type of an investment where the investor has significant influence over. So because of that, we follow a special accounting treatment called equity accounting in terms of the associates. So we'll look at how to do the equity accounting through this question. Right, so after understanding the group structure, we can put the figures into the relevant places. In the question, we have the numbers, so these numbers we can put into the relevant places. After going through the balance sheet, take the numbers to the relevant places. And again, I am reminding you, what you consolidate is only the parent and subsidiary, which means you do the line by line addition for the parent and subsidiary numbers only. You don't do the line by line addition for the associate figures because that is not a part of the group, right? Starting from the beginning, I can start from the non-current assets, right? Property, plant and equipment. Property, plant and equipment, open a bracket and say 40,000 plus 31,000. Property, plant and equipment, line by line addition, parent plus subsidiary, not the associate. Then intangible assets. How much? 7,500 intangible assets. Thereafter, we have the investment. Investment parent has made in subsidiary. So this is the cash consideration, 8 million shares, so in thousands, 8,000 shares into 4 rupees 32,000. So I can take that onto the face of the consolidated balance sheet and later on take to the goodwill calculation. But what I'm going to do is straight away I'm going to take this number or this investment to the goodwill calculation as a part of purchase consideration. So the goodwill calculation is there in the working number 3. So I would say that purchase consideration paid by cash because there's a deferred consideration as well. How much? 32,000. Right? I'm not taking that to the final column because we'll take the deferred consideration as well and then take the total to the last column. So the purchase consideration 32,000. So this is taken to the goodwill calculation, right? Then the investment made in Augusta. So this is the parent's investment in the associate. So equity accounting means what we do is we take initially the cost of the investment plus share of the post-acquisition net asset of the associate. So the initial investment is how much? 10,000. That has to be taken to the working number 6 investment in associate account, right? If I go to the investment in associate working number 6, I can say cost of the investment is 10,000, right? Cost of the investment is 10,000. That has been taken to the working number 6. After that, what we have is current assets, but before writing the current assets, what you will do is you have to keep a space for goodwill. Goodwill of S coming from working number 3. Then thereafter, I also need to keep a space for the investment in associate balance. Okay. Investment in associate. That will be coming from working number 6. Right, working number 6. Always keep these line items because those would be taken to the face of the consolidated statement of financial position after completing the workings, right? After that, what I have is the current assets. Inventory, parent's inventory 11,200, subsidiary 8,400. Again, all assets, all liabilities of the parent and subsidiary, line by line addition. Okay. So current assets, inventory, how much? 11,200 plus 8,400. 11,200 plus 8,400 inventory. Then trade receivable, do the same thing, line by line addition of the parent and subsidiary. Trade receivable, $7,400 plus 5,300 trade receivable. Then bank 3,400. Parent has a positive bank balance that is taken over here. Subsidiary doesn't have any positive bank balance. Right, so the current assets line by line added. Thereafter, what we have is the equity. In the equity section, you need to be careful. Why? You don't do the line by line addition for the equity items, right? What we do is all the equity items or all the net asset of the subsidiary, we take to the working number 2 net asset table, right? Then parent's equity, you can take to the face of the consolidated balance sheet, right? But for the parent's retained earnings, without taking straight away to the consolidated balance sheet phase, what we do is we do a separate working and take the number because a lot of consolidation adjustments are taken place through the parent's retained earnings. Okay. Similarly, if parent company is having any other reserves, in this case only the retained earnings is there. Let's say there's a reserve called other components of equity. So what you do is you do a working and take the answer to the consolidated statement of financial position. But in this question and most of the questions, what we have is the retained earnings, so that we do a separate working and take to the face of the consolidated statement of financial position. Right, let's see how do we do that, right? Equity. So equity shares of the parent, you take to the face of the consolidated statement of financial position. Equity shares. So the parent company has how much? 50,000. Subsidiaries equity shares, which is how much? 10,000. What you do is you take that to the net asset table of the subsidiary, right? Working number 2. So you can say equity shares. How much is the figure in terms of the subsidiary? 10,000, right? So this is actually the reporting date figure, because balance sheet is given for the reporting date. Now the reporting date share capital of the subsidiary is 10,000. Then the question is, what is the share capital or the equity share value of the subsidiary at the date of acquisition, which is on 1st January 2020 in this question. Here there is no mentioning a share issue by the subsidiary after the acquisition. So that what we assume is the number of shares that the subsidiary had even at the acquisition date was same as the reporting date share capital, right? So that acquisition date also I can assume that the share capital is 10,000. So which means post acquisition means the change from the acquisition date to the reporting date. So there is no change. So how do you get that? Reporting date figure minus the acquisition date figure, which is 0, right? So again, parent's share capital I have taken to the face of the consolidated balance sheet. Subsidiary share capital I have taken to the net asset table. Then the retained earnings. As I mentioned, I can take the parent's retained earnings to the face, but there are a lot of consolidation adjustments which are taken place through the consolidated retained earnings. So what we do is, or the parent's retained earnings, consolidated retained earnings means retained earnings belongs to the parent. So because of that, what we do is retained earnings of the parent I am taking to the working number 5. Now if you look at the retained earnings balance at the beginning of the year 25,700, and during the year there's a profit figure generated by the parent company 9,200. What we take is the total value. Now if you take the total of the retained earnings balance of the parent company at the year end, 25,700 plus 9,200, how much? 34,900. What we can do is we can take that to the consolidated retained earnings with regard to the parent company. How much? 25,700, 9,200. $9,200. So what's the total? 25,700, 9,200. So the total I can take to the final column. $34,900. Then that is the parent's retained earnings. What are we going to do with the subsidiary retained earnings? All the equity items of the subsidiary is taken to the net asset table, working number 2. Now, if you look at the subsidiary retained earnings, at the beginning of the year, 12,000, that is the date even the subsidiary was acquired. So basically acquisition date, retained earnings of the subsidiary 12,000, because subsidiary was acquired by the parent company on 1st January 2020. And if you look at the retained earnings of the subsidiary at the reporting date, you can add these two together, 12,000 plus 6,000, 18,000. So what I do is I go to the net asset table and record that retained earnings of the subsidiary. How much is at the reporting date? The total 12,000 plus, that is the beginning of the year retained earnings plus during the year profit. So 18,000, right? Then acquisition date is the, so the acquisition date is the 1st January 2020. What is the retained earnings of the subsidiary on that date? 12,000. I hope you understood. Then post acquisition means the change in the retained earnings from acquisition date to the reporting date, or actually that is the during the year profit, because subsidiary was acquired at the beginning of the current financial year. So 18,000 minus 12,000, that is 6,000. Okay. Now the equity items of the parents and the subsidiary we have taken to the relevant places. Then before moving to the non-current liabilities, on the face of the consolidated statement of financial position, we need to keep a space for, first of all, consolidated retained earnings. That will be taken from working number 5. right? That will be taken from working number 5. Similarly, you also need to keep a space for the non-controlling interest that is to be taken from working number 4. Because non-controlling interest means what? Subsidiaries, shareholders other than the parent company. Now, parent has acquired 80% of the subsidiary, which means 20% of the subsidiary is held by the outside shareholders, non-controlling interest. So that is part of equity. So that has to be taken to the equity section of the consolidated statement of financial position. Then let's look at the liability section. When it comes to the liabilities, we have non-current liabilities and the current liabilities. So the treatment is very simple, line by line addition. Parents liabilities plus subsidiary liabilities. First of all, non-current liabilities, deferred tax liability. How much? 15,000 plus 8,000. Okay. Then moving to the current liabilities, what we have is bank overdraft. Okay, so the parent doesn't have overdraft, subsidiary is having 2,500 overdraft. So that is coming under the current liabilities. Then trade payable. How much? 11,600 plus 6,200. Right. So now we have taken actually all the relevant figures of the balance sheet of the parent and the subsidiary into the necessary places. Okay. All the figures have been taken to the relevant places. Okay. Next, what we need to look at is we need to look at the adjustments, right? And also unrecorded transactions. If we have any unrecorded transaction, we need to record those. Now, in this question, when we are reading the question, we figure it out. Immediate payment of 4 rupees per share made by the parent company to the subsidiary was recorded, but the deferred consideration of 5.4 million that has to be paid after 1 year from the date of acquisition, 1st January 2021, is not recorded. Okay, so here it's clearly mentioned. Immediate payment has been recorded in the Paladine's financial statement, but the deferred payment has not been recorded. Okay, so the cost of capital is 8%. So we learned whatever it is included within the purchase consideration, that has to be measured at fair value, right? So which means now in the case of the deferred consideration, what is deferred consideration? Payment made not at the date of acquisition on a future date. So how to calculate the fair value? You need to calculate the present value of the future cash outflow, that is equal to the fair value of the deferred consideration. Now, when it comes to the acquisition date, because you calculate the goodwill at the date of acquisition and the purchase consideration to be measured at fair value at the date of acquisition. Now, when you look at the time period comparing with the date of acquisition, the deferred payment is made in 1 year's time, where the discounting factor is 8%. So we can calculate the present value. So we can do a working actually, as I mentioned. In addition to the mandatory workings, based on the requirement, you need to do the additional workings. So I would say working number 7 to calculate the deferred consideration. Deferred consideration. So the present value to be calculated, so the amount of the payment is 5,400 in thousands, that has to be paid in 1 year's time. So you know how to calculate the discounting factor, 1 divided by 1 plus r to the power n. R means the discounting factor, in this case discounting factor is 8%, n means the number of years. Number of years is from the acquisition date in 1 year's time. So 1 divided by 1 plus r to the power n means 1 divided by 1.08. So what you do is 5,400 you divide by 1.08. Okay, into the power 1, into the power 1. Right, even you can ignore into the power 1 because it's the same. Right, so let's take the answer. 5,400 divided by 1.08. What is the answer? Present value is 5,000. So this is actually the fair value of the purchase consideration. What is the double entry of that? Where to debit and where to record, where to credit? Because remember, this particular consideration is not recorded. If there's any unrecorded transaction, you have to record the debit entry as well as you have to record the credit entry. So where to debit, I would say debit purchase consideration how much? 5,000 this value. And where to credit, it's a liability, right? It's a liability. It has to be paid on a future date. Okay, payment must be made on a future date. Liability. So the liability account, I can say deferred consideration. Which is a liability. How much? 5,000. Right, we have to record this transaction. How to record? Debit purchase consideration. That means purchase consideration is taken to the goodwill calculation. So this is my goodwill calculation. I can say purchase consideration deferred how much? If I can even give the cell reference, what is the deferred consideration? 5,000, right? And where to credit? I credit that to a liability account. So is it non-current liability or current liability? Now if you look at the balance sheet date, what is the balance sheet date? 31st December 2020. From the balance sheet date, actually it has to be paid in 1 day's time. It has to be paid on 1st January 2021, right? Because the subsidiary was acquired on 1st January 2020. So from that point onwards, 1 year. Now if you look at the balance sheet date, 31st December 2020, in 1 day, right? It has to be paid, so that it has to be a part of the current liability. I can include that under the current liabilities. Deferred consideration. How much? 5,000. Always give the reference to the working number. Working number 7, then it's easy for the marker to refer what you have done. Working number 7. And even here, when calculating the goodwill, I can give the reference to the working number. Working number 7. Okay, here N is missing. Right, okay, 5,000, right? So you see the double entry, debit to the purchase consideration, part of purchase consideration, credit entry goes to the liability account. Always for any unrecorded transaction, even an adjustment in the consolidated statement of financial position, ensure that the double entries are passed. Always in the balance sheet, double entry has to be passed. There's a debit entry, there's a credit entry, otherwise your balance sheet won't be tallied. Okay, right, that is done. Then the next thing is, yes, the deferred consideration balance is 5,000, but what you need to understand is, this is the fair value at the rate of acquisition, but when you actually make the payment to the previous owners of the subsidiary, how much you need to pay? How much parent company has to pay? Parent company has to pay 5,400 in 1 year's time. Now, which means the liability what you have recognized on the balance sheet at a value of this 5,000 has to be increased up to 5,400 in 1 year's time. This process is called as unwinding. Initially you discount and take the present value, and thereafter over the period of time you have to unwind that and recognize the unwinding finance cost. Okay, in the deferred consideration you present value, then year by year you do the unwinding. So we need to calculate here the unwinding finance cost. Unwinding finance cost. How to calculate the unwinding finance cost? you take the, now this particular liability, so during the year you need to unwind. That means from 1st January 2020 to 31st December 2020, this is the year. So during this year it has to be unwound. Now, how do you calculate the unwinding finance cost? You take the beginning of the year value of the liability. What is the beginning of the year value of the liability? 5,000. That has to be multiplied by the discounting factor. So the same discounting factor what you have used for the present valuation, I use it for the unwinding, 8%. 5,000 into 8%, how much? 400. You need to calculate the finance cost in this way, and thereafter again you have to record that finance cost. So finance cost means it has to be debited to the P&L. When you are preparing the balance sheet, it is taken to the parent's retained earnings, which is what? Consolidated retained earnings debit. Where to credit? Credit entry goes to the liability account. Okay, deferred consideration liability. So now if I write down double entry here, debit consolidated retained earnings, how much? 400, and credit deferred consideration liability. This is a liability account. $400. Right? Let's pass the double entry again. Consolidated retained earnings means what? Working number 5. Consolidated retained earnings debit. Go to the working number 5 over here and mention unwinding finance cost. Always give the reference to the working number 7. Debit, how much? 400. Debit means what? Minus 400. Even I can give the cell reference, right? Cell reference mean this figure, minus 400. And the liability has to be credited. Debit consolidated retained earnings, credit the liability. Where do we have the liability? Here, deferred consideration. How much? You credit 400, coming from again working number 7. Now what has happened? With this unwinding finance cost, liability value has gone up to 5,400. This is what you need to pay on the next day. Okay, initially you discount, and thereafter with the unwinding interest, liability now is equal to the amount of the settlement. So that has to be settled on the next day, 1st January 2021. So I hope you understood about how to present value the deferred consideration, and thereafter how the unwinding process is taken place. Are we clear with that? Right. Then that is actually about the unrecorded transaction as well as the calculation of the unwinding finance cost subsequently. Now that deferred consideration part is over. Then all other things with regard to the information given before the 3 balance sheets we have now considered. Okay, so now I am moving to the adjustments. Okay, adjustments. So the first adjustment is Paladine's policies to value non-controlling interest at fair value at the date of acquisition. For this purpose, directors of Paladine considered share price of Saracen of 350 rupees per share to be appropriate. Now what I can do is, now if you look at the goodwill working number 3, I can now take the total consideration paid by the parent company to acquire the subsidiary. 32,000 plus 5,000, how much? 37,000. This is the total consideration paid by the parent company to acquire the subsidiary, to acquire 80% of the subsidiary, which means, as I mentioned earlier, 20% of the subsidiary is held by non-controlling interest. So here in this question, non-controlling interest is measured by using the fair value method. Now, when it comes to the fair value method, either the fair value of the non-controlling interest is given in the question, or else examiner will give you the information to calculate the fair value of non-controlling interest. In this question, actually the fair value of non-controlling interest is not given, but we have been given the information to calculate it. How do we calculate? We know at the date of acquisition, which is on 1st January 2020, share price of the subsidiary we know. And number of shares of the subsidiary also we know. 1 rupee each, 10,000 means subsidiary is having 10,000 shares. Out of 10,000, what is the holding of the non-controlling interest? 20%, which is 2,000 shares. Now, can we calculate the fair value of the non-controlling interest at the date of acquisition? Number of shares held by the non-controlling interest 2,000. Share price of the subsidiary at the date of acquisition 1st January 2020 is how much? According to the question, 3 rupees and 50 cents. Multiply the number of shares of the non-controlling interest by the share price of the subsidiary at the date of acquisition. There you get the fair value of the non-controlling interest at the date of acquisition. Right, you can say fair value of non-controlling interest at acquisition. How do you get? 2,000 shares into 350 rupees. Okay, 2,000 into 3.5. How much? 7,000 rupees. So what's the double entry here? This is taken to the goodwill calculation, and also this is credited to the non-controlling interest, because this is the opening value of NCI at the date of acquisition. Right, I can say fair value of NCI at acquisition. Value of NCI at acquisition. So you can even give the cell reference 7,000. So again you see the double entry, right? Debit to the goodwill calculation, fair value of NCI at acquisition, credit to the NCI, opening value of the NCI. Is that clear? Right. And here you can mention how did you get this figure. So basically you don't need to show the working again to say that it is 2000 into 350. What you can say is you can give the working number reference. You have taken this from the working number 3. So if you refer the goodwill working, the calculation method is reflected. How this 7,000 is derived is reflected there. Right. So that is actually the first adjustment that we have now completed. Moving to the adjustment number 2. At the date of acquisition, fair value of Sarasin's property, plant and equipment equal to the carrying amount, with an exception of Sarasin's plant, which had a fair value of 4 million rupees above the carrying amount. Right. So you have to do the what? Fair value adjustment. We learned when parent is acquiring a subsidiary, all the identifiable assets and the liabilities of the subsidiary needs to be measured at fair value. Right. If you have any changes to the carrying value to the fair value, what you do is you have to incorporate those as fair value adjustments in the consolidated statement of financial position. In the subsidiary's individual financial statement, you don't need to make any adjustments. Now, if you look at the subsidiary's individual financial statement, the value of the property, plant and equipment is 31,000. That is not going to be adjusted. That is kept as it is. But at the consolidation level, you have to take the fair value of the assets and the liabilities at the date of acquisition. Okay. So now fair value of a particular plant 4,000 above the carrying value, which means what we need to do is we have to increase the value of the plant, which means property, plant and equipment, by 4,000. At the same time, you have to recognize that 4,000 increase in the acquisition date net asset of the subsidiary. Acquisition date net asset value will go up by 4,000. Property, plant and equipment of the subsidiary at the consolidated financial statements will go up by 4,000. So again, double entry. So the double entry for this particular transaction is you go to the PP&E and add 4,000. So explain the marker what you have done always, FV fair value ADJ. So fair value adjustment. Okay, debit PP&E always double entry. Where to credit? go to the net asset table. So the subsidiary net asset will increase. Where do we have the subsidiaries net assets? In the working number 2. So there you can say fair value adjustment with regard to plant, right? So the acquisition date net assets will go up by 4,000. Debit PP&E, credit acquisition date net asset of the subsidiary. So this fair valuation has to be done only at the date of acquisition, not subsequently, right? So not subsequently. That means this fair value increase in the net asset of the subsidiary, which has happened at the acquisition date, would be prevailed up until the reporting date, right? So the net asset has gone up. So that increase in the acquisition date would be reflected also in the subsidiary's reporting date net assets. So that reporting date column also I am taking same 4,000, right? So post acquisition means no change. Reporting date minus acquisition date, no change, because you don't need to do the subsequent fair valuation. Only at the date of acquisition, to calculate the goodwill correctly, to follow the acquisition accounting, we do this fair value adjustment. Okay. And also again I am reminding, this adjustment is done only at the consolidation level. Right. Then this particular plant has a remaining useful life of 4 years, and subsidiary uses the straight line depreciation method, assuming no residual value. Now what you need to understand is, once we increase the property, plant and equipment of the subsidiary at the consolidation level as a consolidation adjustment, you have to record the relevant depreciation impact also of that particular fair value increase of the depreciable asset. Okay, so because for the consolidation purpose, if you increase the value of the asset, you have to record the additional depreciation as well, again at the consolidation level, right? So because of that, always remember, when we do a fair value adjustment with regard to a depreciable asset, don't forget to record the fair value depreciation as well, again as a consolidation adjustment. How to calculate the amount, we'll look at through a working. Let's take the next working. I would say working number 8. Fair value depreciation. Fair value depreciation. So I can say, first of all, annual fair value depreciation. That is per annum, how much should be the depreciation at the consolidation level because of the fair value adjustment. So the fair value adjustment is how much? 4,000, right? So the useful life, remaining useful life is 4 years, divided by the remaining useful life. So I would say the fair value depreciation would be 1,000 rupees per annum, right? Now, when you are preparing the statement of financial position, you have to take the cumulative impact from the acquisition date to the reporting date. Now, in this question, actually, subsidiary was acquired 1 year ago. So because of that, the depreciation impact, even the cumulative impact, is only for 1 year, right? So, but for the understanding, I will write that as well. Even though the cumulative impact is only 1 year, I'll write that total fair value depreciation. How do we take the total fair value depreciation? Annual fair value depreciation 1,000, which we calculated earlier, into 1 year. So this 1,000 into 1. So the amount of the adjustment is also 1,000 in this question, right? But let's say if the subsidiary has been acquired 2 years ago, then the annual depreciation impact is 1,000. Then the cumulative impact, what it has to be adjusted at the consolidated statement of financial position, would be annual impact of depreciation 1,000 into 2 years, right? Then the adjustment should be 2,000. But in this question, subsidiary was acquired 1 year ago, so the total impact to be adjusted at the consolidated statement of financial position is 1,000. So how to do that? You have to record the additional fair value depreciation because of the fair value adjustment what you have made at the consolidation level. How to do that? You go to the balance sheet, and there you need to deduct 1,000. So the fair value depreciation will reduce the PP&E value. Always give the reference to the working number 8. Working number 8. Double entry again. Credit property, plant and equipment, where to debit? Because of the additional depreciation, fair value depreciation of 1000, subsidiaries net assets will reduce. It is an item which affects the subsidiary profit, which means subsidiaries net asset is getting affected. Net asset will reduce. So where do we have the subsidiary net assets? Net asset table, working number 2. Go to working number 2 and say that fair value depreciation with regard to the plant. Where do you adjust this? Is it at the acquisition date or is it at the reporting date? So this is occurring after the acquisition, throughout the period. Acquisition date net assets are not getting affected because of the fair value depreciation. What is getting affected is the reporting date net assets, because over the period of time only the depreciation impact comes, not at the date of acquisition. So the double entry is credit property, plant and equipment, debit subsidiary net assets at reporting date. Debit means it's a minus figure, minus 1000. Okay. Pluses means credits, minuses means debits. No impact on the date of acquisition. Then what is the post acquisition? Minus 1000 minus 0. That is post acquisition net assets are negative 1000 because of this fair value depreciation. Are we clear with that? Right. So that is how we tackle a fair value adjustment which is happening with regard to an asset of the acquired subsidiary. Okay, so more specifically with regard to a depreciable asset. Now, for an example, let's say sometimes in the examiner would say that this fair value adjustment is relevant with the land. Then what do we do? Then you do the same fair value adjustment. No difference. But there is no fair value depreciation adjustment, right? If it is land, it's not a depreciable asset. So if it is a land, it's very simple. Just to make the fair value adjustment only. Debit the PP&E and credit the acquisition date net assets. And that would be that impact of the increase in the net asset of the subsidiary would be there at the reporting date as well. But there is no fair value depreciation impact if it is a land, because land is not a depreciable asset. Okay, right. Then adjustment number 2, we have another part, right? That is, also at the date of acquisition, Paladin valued Saracen's customer relationship as a customer-based intangible asset at a fair value of 3 million rupees. Saracen has not accounted for this asset. Subsidiary has not recognized this asset. Trading relationship with Saracen's customers last on average for 6 years. Now, in this particular matter, subsidiary has a internally generated intangible asset. What is that? Customer relationships, customer information, customer database, customer buying behaviors, buying pattern and all. So that's an asset that the subsidiary has. But as it is an internally generated intangible asset for the subsidiary, as per the standard, as per LKS 38 intangible asset standard, subsidiary can't recognize this on the individual financial statements of the subsidiary. If you look at the subsidiary's individual accounts, that means in these accounts of the subsidiary, you can't recognize this as an asset. Now the question is, can you recognize this as an asset at the consolidation level through a consolidation adjustment? Answer to the question is yes, if that particular asset is what? Identifiable. Okay. So now parent company has to decide whether the particular intangible asset that the subsidiary has is an identifiable intangible asset or not. Right? What do you mean by identifiable? Identifiability criteria is met if you can separately sell the particular asset, separability, or else if you have a contractual or legal right attached to the asset. Now in this situation, for this particular asset, you can even now customer relationship, customer data, you can separately sell without selling the other assets of the business. Right? So that identifiability criteria is what? Met. Identifiability criteria is met. So the parent company has to recognize the particular asset in their consolidated financial statements as a consolidation adjustment, because for the parent company this is not a internally generated intangible asset, that is a purchased intangible asset. So when parent decides how much of consideration that I'm going to pay to acquire this subsidiary, parent definitely would have considered this particular asset. Okay, so the intangible assets which are generated by the subsidiary in their individual financial statements, when it comes to the consolidation level, what will happen is those assets are recognized, right? Those assets are recognized. Another example would be, similar example would be, if subsidiary is having a brand, right, internally generated brand, the brand is not there in the subsidiary's individual financial statements, but for the consolidation purpose, again what you do is you recognize this particular brand at the fair value. Okay, right. So let's recognize the asset. This particular intangible asset is having a value of 3 million. So what we do is you go to the consolidated statement of financial position, you recognize the asset 3000, debit the intangible asset, and we are to credit. With the recognition of this intangible asset at the date of acquisition, subsidiaries net assets will increase by how much? 3000. Where do we have the subsidiaries net asset? Working number 2 net asset table. So in the working number 2 net asset table, what I can say is, again a fair value adjustment with regard to an intangible asset here. Intangible asset. How much is the fair value adjustment? 3000. So the acquisition date net assets will increase by 3000. Okay. Similarly, this increase in the net asset of the subsidiary at acquisition would be prevailed at the reporting date as well, right? So you fair value the identifiable assets and the liabilities of the subsidiary at the rate of acquisition. So the net asset increase, what it has happened in the subsidiary would be prevailed up until the reporting date as well. So the same 3000 I can take to the reporting date. So the post acquisition again what? 0. Right, 3000 minus 3000, it's 0. I have recognized the intangible asset, debit the intangible asset over here, and I can say that within brackets fair value adjustment, then marker is aware what you have done. Always make the marker's life easy by explaining what you have done. Okay, value adjustment, and that has been debit to the intangible asset and credit to the subsidiary's net assets at the rate of acquisition. Same amount would be prevailed at the reporting date as well. Here also what we to do is, as this fair value adjustment is done at the consolidation level, there can be a subsequent amortization again at the consolidation level, because it's clearly mentioned. So the trading relationship with Sarasin's customers last on average how many years? 6 years. It's only 6 years. If it is 6 years, what we do is this recognized intangible asset at the consolidation level, I need to amortize over 6 years. So let's do a working for that as well. Let's do a working. I would say working number 9. Fair value amortization. Fair value amortization. I can calculate first of all annual fair value amortization. How do I get the annual fair value amortization? Fair value adjustment is 3000, divide that by 6 years, right? So the annual impact would be 3000 divided by 6, it's 500. And yet again, when preparing the consolidated statement of financial position, I need to take the cumulative impact of this fair value amortizations from the date of acquisition to the reporting date. How many years? Just 1 year, right? So because of that annual impact, you need to multiply by 1. If the subsidiary was acquired 2 years ago, annual impact you need to multiply by 2 to take the total impact of this value amortization, right? So let's take the total fair value amortization equals to 500 into 1 here in this question. right? Then this can be adjusted in the consolidated statement of financial position, which means what I need to do is I need to go to the consolidated statement of financial position. So the additional amortization will reduce the value of the intangible assets by 500. So the working number, I can give the reference to the working number 9. That is the credit entry, credit the intangible asset. We have to debit subsidiary. So this is getting affected to the subsidiary profit or the subsidiary net asset at the consolidation level. Where do we have the subsidiary net assets? Working number 2, net asset table. Again, this would have an impact to the net assets of the subsidiary at the reporting date, not at the acquisition date, because amortization is taken place after the acquisition. Okay, so fair value amortization, fair value amortization. How much? Debit means what? Minus reporting date. So here acquisition date, no impact. So which means post acquisition, minus 500 minus 0 minus 500. So the double entry is credit intangible asset 500, debit subsidiaries net asset at the reporting date 500. Are we clear? Right. Okay, so we have now completed the second adjustment as well. Okay, second adjustment as well. Adjustment number 3 is at 31st December 2020, Saracene's and Augusta's inventory included goods bought from Paladin at cost to Saracene and Augusta of 2.6 million and 3.9 million respectively. Paladin had marked up these goods by 30% on cost. Right. There are intercompany transactions between parent and subsidiary and parent and associate. Right. Now, what we need to understand is, now intercompany transactions are to be eliminated at the consolidated financial statements. Intercompany balances are to be eliminated at the consolidated financial statements, as well as if you have any unrealized profits with regard to the transactions which have been taken place between the group companies are to be eliminated. Now, in this situation, what will happen is there would be a scenario of an unrealized profit because certain goods sold by the parent company to the subsidiary, first of all, with regard to the subsidiary, is remain unsold in the subsidiary's books. Now, parent has made a profit when selling these goods to the subsidiary. If subsidiary sold these goods to the outsiders, third parties, then there's no issue. Then you don't need to make any adjustments to the unrealized profit. But if the subsidiary has not sold these goods to the outsiders, it is there in the inventory of the subsidiary at the year end. So the profit earned by the parent company is unrealized when you take the group perspective. When you take the parent and subsidiary together from the group perspective, the profit is unrealized. That has to be reversed. Okay, so first of all, we need to calculate the unrealized profit of this transaction between the parent and the subsidiary. For that, we'll do a working. Let's say working number 10. Unrealized profit with regard to inventory P to S. P sold goods to the subsidiary. Parent sold goods to the subsidiary. Right. So here, first of all, when calculating the unrealized profit, we need to understand the relationship, right, among the cost, profit and the sales. Now, in this question, markup means what? From cost, markup of 30%. So which means if I look at the relationship, cost, then profit and sales, selling price. Okay, so what is the relationship? Markup of 30% means if the cost is 100, profit has to be 30, which means sales is equal to cost plus profit. Cost plus profit is 130. Okay, so always in the question, if it's mentioned markup from the cost, if it is margin from the sales. Okay, right. Now what we need to understand is then what is the profit made by the parent company by selling the goods to the subsidiary. According to the question, so the inventory of Saracen includes goods bought by the parent company, which is the cost to the Saracen. Cost to the Saracen 2.6 million rupees. So the cost to the buyer, subsidiary is the buyer, Saracen is the buyer. Cost to the buyer is equal to the selling price from the seller's point of view, selling price from the parent's point of view. Now 2.6 million is the cost to the subsidiary, means which is the selling price to the parent company. Now how are you going to calculate the profit element? Okay, how are you going to calculate the profit element? You can say unrealized profit amount is equal to the 2.6 million, means in thousands 2600. This is the cost to the subsidiary, means selling price to the parent company. What is the selling price? 130. So to calculate the profit element, what you need to do is you have to divide this by 2600 by 130 and multiply it by 30. So you have to take 30 over 130 to calculate the profit element. How much is that? 2600 divided by 130 and multiplied by 30, which comes to 600. This is the unrealized profit amount, right? So the actually in this particular transaction, cost of the inventory to the parent should be 2000. Parent has added 600 profit and made the selling price to 2600. So that's why 2600 is equal to the selling price, which is 130. So to calculate the profit element, you have taken 2600 divided by 130 and multiplied by 30. It is 600. So what's the double entry that you need to pass? You need to eliminate this unrealized profit. You can't keep this unrealized profit at the consolidated financial statements. So the double entry is, who is the seller? Parent is the seller. So the unrealized profit is there in the parent's books. You have to reduce the parent's profit. So here, what reflects the parent's profit is the consolidated retained earnings. So what we need to do is, debit entry goes to the consolidated retained earnings, consolidated retained earnings debit 600, and where to credit? So the profit element is included within the inventory figure. So you have to reduce the inventory by taking out the profit element. So the credit entry goes to the inventory. So the inventory is there with the subsidiary. So the subsidiary inventory is there on the consolidated balance sheet. We have already taken the subsidiary inventory to the consolidated balance sheet. You credit the inventory. How much? 600. Let's pass this entry. So go to the consolidated retained earnings, working number 5. I can say unrealized profit with regard to inventory from parent to P to S. I even can give the reference to the working number. What is the working number? Working number 10. Working number 10. Debit means it has to be a minus. Okay, debit consolidated retained earnings. You can give the cell reference minus 600. And where to credit? Credit inventory. So go to the face of the consolidated balance sheet. So inventory you can deduct by 600. Working number 10. Give the reference to the working number. So always ensure debit and the credit entry is passed. Right. That is done. That adjustment is done. Then I need to explain you one more important thing. That is, in this question, parent is the seller, subsidiary is the buyer. So we know how to calculate the unrealized profit we looked at, as well as how to pass the double entries we looked at. But let's say I'm going a bit outside to the question for you to explain the concept. So sometimes what can happen is this particular transaction can happen in other way around, which means same information, same numbers, but subsidiary is selling goods to the parent company. Then how are we going to do the calculation? Right? If I take an example, I'll take a copy of this, right, to the right hand side. This is just to explain you the concept, right? And also I put a different color to say that this is not a part of the answer. This is just for your knowledge, right? Same numbers, same markup of 30%, cost is 100, profit is 30, selling price is 130. Only difference is subsidiary sold goods to the parent company. Now the inventory is with the parent company. Seller is the subsidiary. Yet again, it's a what? Unrealized profit scenario, right? Because parent and subsidiary is within the group. You need to first of all calculate the unrealized profit. When calculating the unrealized profit, there is no difference at all. So now 2600 is the cost to the parent company, selling price from the subsidiary's point of view. So subsidiary has to understand what is the unrealized profit element now. Selling price is 2600, divide that by 130 and multiply it by 30. Then you get the unrealized profit. How much? 600. So the calculation of unrealized profit is not going to be changed. Whoever the seller and the buyer is, parent to subsidiary or subsidiary to parent. No change in the computation. What is getting changed is the double entry. Because why? Now, who is the seller? Subsidiary is the seller. If subsidiary is the seller, unrealized profit is there with the subsidiary, you need to reduce the subsidiary profit. You have to eliminate the unrealized profit from the subsidiary's perspective. So it has to be debited to the subsidiary retained earnings, not to the parent's retained earnings, not to the consolidated retained earnings. So the debit entry, what will happen is, this would be taken to subsidiary retained earnings. Where do we have the subsidiary retained earnings? In the net asset table. So in the net asset table, this is taken to the reporting date column, right? That is in working number 2, I would say working number 2, net asset table, reporting date column. Reporting date column. Reporting date, net assets. Reporting date, retained earnings of the subsidiary will get reduced. Debit 600 and credit inventory, because inventory is with the parent company. So credit inventory, parent's company inventory is there on the consolidated statement of financial position. I hope you understood, right? So that means retained earnings of the subsidiary means, if I go and show you, so in this net asset table, this particular column, reporting date column, you have to debit 600. Debit means what? Minus 600. Okay. There's no impact to the acquisition date column. So minus 600 to the reporting date column. So the post acquisition would also be minus 600. Right? That is additional information or additional knowledge what I wanted to tell you with regard to the unrealized profit adjustments. Right. Okay. Now coming back to the question that I'm discussing. Now we looked at the unrealized profit adjustment from parent to subsidiary. Here also, in the adjustment number 3, there is an unrealized profit adjustment with regard to the parent and associate as well, right? So same terms means with same markup, parent sold goods to the associate. Augusta is having 3.9 million worth of inventory at the closing inventory. So yet again, this is the cost to the associate. 3.9 is the cost to the associate and selling price from the parent's point of view. What we need to do? We need to now yet again calculate the unrealized profit. So let's do a working for that. Working number 11, unrealized profit, inventory P to A. Okay, P to A. Yet again the relationship is same. I can copy this. Same relationship. Markup of 30%, that means cost is 100, profit is 30, that means selling price is 130. Yet again I am going to calculate the unrealized profit. So the cost to the associate is 3,900, which means selling price of the parent is 3,900. So how to calculate the unrealized profit? 3,900, which is the selling price, that has to be divided by 130 and multiplied by 30 to calculate the profit element. So into 30 upon 130. So this is how you calculate the unrealized profit. How much is the amount? 3,900 divided by 130 multiplied by 30. How much? 900. Now the point is, parent and associate, or the investor and the associate, are not the part of the group. So because of that, when it comes to the unrealized profit elimination, the transaction between the group companies and the associates, you do not eliminate the full amount of the unrealized profit. What you eliminate is the share of unrealized profit. What is the investor's share of investment in associate? Investor has acquired 25% of the associate. Then when we are eliminating the unrealized profit, what we need to eliminate is not the full unrealized profit, share of unrealized profit. So how to take the share of unrealized profit? Full unrealized profit is 900. What is the investor's investment in associate? 25%. Okay, 25% here under the group structure. P acquired 25% equity shares of A. Okay, that comes to 900 into 25%, 225. This is what we need to eliminate. This is what we need to eliminate. So talking about the double entry, here it's investors' share. So always what we eliminate? Investors' share. So because of that, always the debit entry goes to the investors' books. Okay, irrespective of who is the seller. Here remember, irrespective of who is the seller, if the unrealized profit elimination is with regard to the associate, whether the investor is the seller, whether the associate is the seller, always where you debit is the consolidated or the investor's retained earnings. So you debit consolidated retained earnings. How much? 225. Then where to credit? Who is having the inventory now? Associate is having the inventory. Can I credit inventory balance? On the face of the consolidated statement of financial position, what you have is only the parent's inventory plus subsidiary inventory. Associates inventory, we have not done the line by line addition. It is not there on the face of the consolidated statement of financial position. So in that case, can we credit inventory? No, you can't, because the inventory is with the associate. Then where should I credit? Remember, representing all assets and all liabilities of the subsidiary with regard to the all assets and all liabilities of the associate, not the subsidiary, associate, you have only one account. What is that account? Investment in associate account. So the investment in associate account represent all the net assets, liabilities of the associate. So because of that, what you do is, you can't credit inventory, you can credit investment in associate account that represents the associate inventory. I hope you understood. The credit entry goes to investment in associate. Investment in associate. How much? 225. Right? So let's pass the double entry. So where do we have the investment in associate? Working number 6. We do a working for that, right? Here. Investment in associate. So the debit entry goes to the consolidated retained earnings, unrealized profit, inventory, P to A, right, coming from working number 11. Okay, how much to debit? Debit means minus. I can give the cell reference. 225. Debit consolidated retained earnings and credit to the investment in associate. URP inventory P to A. Here also working number 11. Credit. So the investment in associate is a debit balance. It has to be credited to the investment in associate. That means again minus how much? 225. Right. So this is how you make the adjustment for the unrealized profit where a group company or the parent company sold to the associate. Right. I hope you understood. Yet again, to make you aware about what will happen if the transaction has happened in other way around. Not a part of the question, right? But for your knowledge, if I do the computation, if I take a copy of this to the other side, okay, we take a copy of this over here. So what will happen? The same thing, only thing is, who is selling to whom? Associate is selling to the parent company, right? Same numbers. So the relationship would be cost 100, profit 30, sales 130, markup of 30%. Then what you do? Now associate is the seller, selling price from the associate's point of view 3,900, cost to the parent 3,900. You need to calculate the unrealized profit. How to calculate the unrealized profit? 3,900 divided by 130, that is equal to the selling price, multiplied by 30. Then you calculate the unrealized profit, 900. And also you have to take the share of unrealized profit. Okay, so the share of unrealized profit to be taken by taking the unrealized profit amount, which is 900, into investors' share of the associate. That is what? Multiplied by 25%. So the share of unrealized profit is 225. That means there is no change. There is no change in the case of the computation. Computation, there is no change. Right? What is getting changed is the double entry again. When it comes to the double entry, where to debit is not going to be changed because you adjust only the investor's share of the unrealized profit. As it is investor's share, you have to debit to the investor's retained earnings, which is what? Consolidated retained earnings, 225. Debit entry is same. Where to credit? In this situation, who has the inventory? Associate sold goods to the parent. Parent company is having the inventory. Parent's company's inventory is there on the consolidated statement of financial position. Then where you should credit? You should credit to inventory. You should credit to inventory, right? So debit consolidated retained earnings 225, credit inventory 225. So again, I'm telling you these areas what I have highlighted in light blue are not a part of the answer. So if I mention, so this is actually unrealized profit computation with regard to inventory for the goods sold by A to P. Okay. At the same time, previously, if I take a copy of this, what I have shown in the light blue is unrealized profit inventory where the goods are sold by subsidiary to the parent company. Okay, S to P. Right, for your knowledge, I have put these numbers as well to understand. Okay, because in the exam we don't know whether it is subsidiary to the parent or parent to the subsidiary. Similarly, parent to the associate or associate to the parent. Okay, now it is covered. Everything is covered. So that's why I said that this particular question discuss all the possible consolidation adjustments that can be tested with regard to a basic group at the consolidation level. Okay, right. Okay, then let's move to the next adjustment. So we have looked at the adjustment number 3. We have completed the adjustment number 3. Moving to the adjustment number 4. What it says there, Paladine's current account balance with Saracen at 31st December 2020 was 2.2 million rupees, which did not agree with Sarasin's equivalent payable due to a payment of 0.9 million made by Sarasin on 28th December 2020, which was received by Paladin which was not received by Paladin until 3rd January 2021. Right. So normally intercompany balances, intercompany current accounts between group companies, that is parent and subsidiary, has to be tallied, because why? Same transaction is accounted by both parties. If the intercompany transactions are tallied, as I mentioned earlier, what we do is these balances are to be eliminated, because you can't have receivable and payable to each other, because in consolidation we consider parent and subsidiary as a single economic entity. So the intercompany balances, intercompany transactions are to be eliminated. Another example would be if, let's say, parent has given a loan to the subsidiary. So the loan is there as a financial asset in the parent's books. So the loan is there as a financial liability in the subsidiary's books. When you are preparing the consolidated balance sheet, what you need to do? We need to eliminate. Now, in this particular question, before elimination, I have to do one thing. That is, I have to make these balances tallied, because at the moment the balances are not tallied. The reason is, in the parent's books, there's a receivable balance from the subsidiary 2.2 million, that is in thousands, 2,200. But subsidiary book payable balance is not matched with this. The reason is, subsidiary has made a payment of 0.9 million, that is 900 in thousands. Subsidiary has made a payment, and that payment is deducted from the payable balance of the subsidiary, right? But parent company has received this payment or the check after the year end, so that it has not been deducted from the receivable balance in the parent's books, right? So there are transit items. In this case, what we have is a cash in transit. When you have a transit items, right, there are two types: cash in transit and goods in transit. I'll come to goods in transit after discussing this adjustment. When you have the transit items, what you need to do is, the transaction has to be recorded in the party in which the transaction is not being recorded, or it has to be recorded in the recipient's books. In this case, who is the recipient? Parent company is the recipient, right? Subsidiary has already recorded the transaction, but not the parent company. Record the unrecorded transaction in the parent's books or the recipient's books. So once you record the transaction, what will happen is intercompany balances will get tallied. So after that, you can eliminate. So let's see how to do that. Let's do a working for that to understand. Working number 12. Intercompany balances. Intercompany balances. What will happen? In the parent's books, there's a receivable. In the subsidiary's books, there's a payable. Right? What is the receivable balance in the parent's books? 2,200. 2.2 million. 2,200. In the subsidiary books, what has happened was, it would have been 2,200, but there's a payment made. The value is 900. Once the payment is made in the subsidiary's books, what is the double entry that is recorded? Cash credit and debit the payable balance. So 900. Once this 900 is deducted from the payable balance of 2,200, at the moment, what is the payable balance? 2,200 minus 900. 2,200 minus 900. So it is at the moment how much? 1,300. So these two are not matched with each other, not tallied. Why? There's a cash in transit. Now what we need to do? Record the transaction in the recipient's book. Parent has to record the transaction. So keep a space, like couple of lines, keep a space, and the double entry, what you need to pass in this situation is, parent has to record means debit cash in transit, cash in transit. Okay, this is called as abbreviation CIT. CIT debit how much? 900. CIT debit 900. Okay, and where to credit? It has to be deducted from the receivable balance. Cash in transit debit, credit receivable. $900. Right. Now, what we do is we have to record this transaction. Now, once we record this transaction, what will happen? This is the receivable balance in the parent's books, right? So, let's record the transaction first. Debit cash in transit. So, you go to the consolidated balance sheet. So, under the current asset, what I can do is I can show CIT, cash in transit. I can say the working number. What is the working number? Working number 12. Always give the reference to the working number 12. How much is the value of the cash in transit? You can even take to the final column. How much? You can give the cell reference. Cash in transit 900. You record that. Okay, and credit to the receivable. So once you record the cash, you need to credit receivable. How much? 900 credit coming from working number 12. Right, that is recorded. Then go to the working, and this is the working from the receivable. Let's record the CIT. CIT debit, receivable, credit. Credit means what? Minus 900. Okay, this is done. On the balance sheet, I deducted and show credit receivable. So here no impact. So then after this deduction, now what is the receivable balance? 2200 minus 900, 1300. Payable 1300. Now what is happening? They are tallied. Intercompany balances, intercompany receivable and the payable balances are tallied. What we can do? We can eliminate. Eliminate means eliminate from the receivable credit, eliminate from the payable debit. Okay, parent is having a receivable 1300, subsidiary is having a payable of 1300. Eliminate from both places. So go to the consolidated statement of financial position, minus 1300. Again, you can show the working number. What is the working number? Working number 12. Receivable credit, payable debit. Trade payable over here. Debit means minus 1300. Working number 12. Right. So that's how we eliminate the intercompany balances after getting them tallied. Right. So that is actually the adjustment number. Adjustment number 4. Right. Then what we need to do is, before moving to the current account balances between the parent and the associate, let me explain about this goods in transit as well. Again, not a part of this question, not an answer to the question, but yet for your knowledge, right? Now, similar to the cash in transit, there can be a situation where a goods in transit. Goods in transit means what? Let's say parent is selling certain goods to the subsidiary. At the time of the sale, let's say this has happened just before the year end. Parent is recording the transaction. How does parent record the transaction? Parent recognize the revenue, credit sales revenue, and debit to the receivable from the subsidiary. It is recorded by the parent company. But goods are not reached to the subsidiary up until the year end. Goods are received by the subsidiary after the year end. Now subsidiary has not recorded this as a transaction in the books. Okay, so because of that, payable balance of the subsidiary does not include this purchase made by the parent company. So what will happen? Receivable balance in the parent's books is higher than the payable balance in the subsidiary's books. Why there's a difference? Because there are certain goods in transit. So what we need to do? Similar to this, we have to record the unrecorded transaction in the recipient's books. In this case, who is the recipient? In my example, subsidiary is the recipient. Subsidiary has to record this. So how does subsidiary record this? Subsidiary would debit goods in transit and credit the payable. Goods in transit debit, credit payable. Then once you pass this entry, this payable balance in the subsidiary books would be tallied with the receivable balance in the parent's books. Then you can eliminate. After passing that entry, goods in transit entry, GIT debit, credit, payable in the case of the subsidiary. Are we clear? And also you need to note one important point with regard to goods in transit. Why? When you have a goods in transit adjustment, automatically there will be an adjustment with regard to unrealized profit as well. Because why? Parent sold the inventory with a profit in my example. Right? So this profit element is unrealized from the group perspective because inventory is there with the subsidiary at the end. It is not sold to the third parties. Obviously, if the subsidiary has not received the inventory, it has not been sold to third parties. Inventory is there in the goods in transit of the subsidiary's books. The profit element earned by the parent has to be eliminated as an unrealized profit. So it's additionally a complicated thing when you have a goods in transit, elimination of unrealized profit. That is not there with regard to what? Cash in transit. There's nothing called unrealized profit in the cash in transit. Okay, so I'm not going to explain the unrealized profit adjustment again because I already explained about the unrealized profit adjustment with regard to inventory. I hope you are clear about that. Okay, so that is about the adjustment. So we are in the adjustment number 4. So that is actually one part of it. And also there's one more information. So now we looked at what are we going to do with the intercompany balance between the parent and the subsidiary. Then it's about intercompany balance between the investor and the associate. Paladine's agreed current account balance owed by Augusta 31st December 2020 was 1.8 million. Now Paladine is having because Paladine has sold goods to the associate as well, Augusta as well. So because of that, there are intercompany receivable and payable balances between the investor and the associate. What is the value of the balance at the year end? 1.8 million. Okay, 1.8 million, the balance. So what are we going to do? So let's say there's a receivable balance in the parent's books, 1.8 million. There's a payable balance in the associate's books, 1.8 million. So the balances are tallied. What are we going to do? What are we going to do? Are we going to eliminate? No. Remember, intercompany balances between the group companies and the associate, we are not going to eliminate. What is the reason? Because associate is not a part of the group. We have not consolidated the line items of the associate. Right? So remember, intercompany balances between the group companies and the associates are not eliminated. No adjustment is required here. What we can do is we can put a note and mention. Okay, so we can put a note and mention here intercompany balances or intercompany transactions and balances between group companies and associate is not or are not eliminated at the consolidation level. because associate is not a part of the group. Okay. Right. Intercompany transactions and balances between group companies and associate are not eliminated at the consolidation level. Right. Done. So now we discussed about the adjustment number 4. Moving to adjustment number 5. So that is Paladin transferred an item of plant to Saracen for 2.5 million rupees, which had a net book value of 2 million at 1st January 2020. Remaining useful life of the plant at the date of the transfer was 5 years. Now this is a intercompany transaction where parent has sold a plant PP&E item to the subsidiary with a profit, because net book value is 2 million, in thousands 2000, it was sold for 2.5 million, in thousands 2500. Right? So which means obviously the plant bought by the subsidiary is there at the year end. Subsidiary is not going to sell this plant to an outsider. So the profit made by the parent company would become unrealized. In the case of inventory transfer, let's say if the inventory is sold by the subsidiary to the outsiders, there is no adjustment required for the unrealized profit. If the inventories remained at the year end only, you have to make this unrealized profit adjustment. In the case of the PP&E items, so the buyer or the buying company is not going to sell that to the outsider, so that the profit is unrealized from the group perspective. So that you have to recognize this unrealized profit adjustment. In addition to that, as this is a depreciable asset, there's an impact on depreciation as well. There's a reversal element of depreciation as well. So to understand how to make this adjustment, let's prepare a format for this. I would say this is working number 13, unrealized profit with regard to PP&E or the non-current assets, P to S, parent to subsidiary. I have to have a table here. In this table, first of all, I need with transfer. I'll explain about this. With transfer. Then another column, without transfer. And the final one is difference. Now, with transfer mean once the asset is transferred from the parent company to the subsidiary, after the transfer, what is the carrying value of the asset as at the reporting date, because this transaction has been happened at the beginning of the current financial year, 1st January 2020. When it comes the reporting date, 31st December 2020, what is the carrying value with the transfer in subsidiaries books? If I do the calculation there, cost. So the cost is the price paid by the subsidiary. Subsidiary paid 2,500 to buy the plant to the parent company. So the selling price from the parent's company is 2,500. That is the cost to the subsidiary in the subsidiary's books. So the plant is recognized initially at a cost of 2,500. That is 1 year ago. Then when it comes the reporting date, you have to recognize the depreciation. Depreciation is also for 1 year because this transaction has been taken place 1 year ago. If the transaction has been taken place 2 years ago, you have to take the 2 years accumulated depreciation. But here it's only 1 year. I would say accumulated depreciation. How do we calculate? In the case of with transfer, 2,500 divided by 5 multiplied by 1. Only 1 year has passed from the date of the transfer. So the accumulated depreciation is 500, which means net book value or the carrying value as at the year end, I would say carrying value is 2000 with the transfer. Then the second column is without the transfer. Without the transfer mean if this transaction has not been happened, if the asset is remained in the parent's book, what would have been the carrying value by now? 31st December 2020 at the year end, what would have been the carrying value? If the asset is there in the parents' books, at the date of the transfer, what was the carrying value? 2 million. Right? If the asset is not transferred, it is still at the date of the transfer, the carrying value or the cost, I would say, in this particular computation would have been 2000. Then what would have been the accumulated depreciation? Again, it has to be depreciated over 5 years, but what is the cost? 2000. So what is the accumulated depreciation only 1 year from the date of the transfer to the reporting date? I would say 2000 divided by 5 multiplied by 1 again. Accumulated depreciation would have been 400. So carrying value without the transfer would have been 1600. 2000 minus 400. So then I am taking the difference, right? Difference of the cost as well as the accumulated depreciation, I am taking it. So what is the difference between the cost? 2500 minus 2000, which is how much? 500. And the difference between the two accumulated depreciation, 500 minus 400 minus. How much? Minus 100. And if you look at the difference between the carrying values, 2000 minus 1600, which is 400. Now what you need to understand here is, by selling the asset on 1st January 2020, parent company initially made a profit of 500. So from the group perspective, this is unrealized profit. Parent recognized this profit in the financial statement of the parent company, but it is unrealized from the group perspective. So what we need to do? We need to eliminate that unrealized profit. How to eliminate the unrealized profit? In the parent's books, you need to pass an entry. So the seller is the parent company. So if the seller is the parent company, that has to be deducted from the parent's profit. That means consolidated retained earnings. I would say debit consolidated retained earnings. Debit consolidated retained earnings. How much? The initial profit, that is this 500. Debit, and where to credit? So the asset is kept in the subsidiaries books at the price where the subsidiary paid. How much subsidiary paid? Subsidiary paid 2500. So, but at the group level, value of the asset should be 2000 at the rate of the transfer. So where you should credit, then you have to credit the PP&E to bring the value down from 2500 to 2000. So debit the parent's retained earnings, consolidated retained earnings, credit the PP&E. Credit PP&E. So the PP&E item in the subsidiaries books, subsidiary PP&E are there on the consolidated statement of financial position. You credit PP&E 500. That is done. So this is understood by you. Okay. In addition to that, now we eliminated the unrealized profit. So eliminated the unrealized profit means I am bringing down the cost at the consolidation level from 2500 to 2000 again, right? Because I credit 500 to PP&E. So with this entry, cost of the PP&E will bring down from 2500 to 2000 at the consolidation level. Then what happened was, subsidiary has recorded the depreciation in the accounts of the subsidiary for the first year, because the asset was bought at the beginning of the current financial year. So during the current financial year, that means for 1 year period, subsidiary has recorded accumulated depreciation of 500, right? But when it comes to the group level, depreciation would have been 400. If I bring down the asset value from 2500 to 2000, accumulated depreciation by 31st December 2020 should be only 400. Now subsidiary has depreciated more than the requirement by how much? 100. There's an additional depreciation recorded in the subsidiaries books. what do you do? That has to be reversed. What do you mean by that has to be reversed? So the reversal of depreciation. So the subsidiary depreciated 500. Now I need to make it to 400. I am taking the accumulated depreciation figure. So subsidiary recorded accumulated depreciation in the individual financial statements of the subsidiary 500. I need to bring that up to 400. So that's a what? Reduction of depreciation is a credit to the subsidiary P&L. Okay. So the depreciation is getting reversed. Subsidiary P&L credit. Where to debit? PP&E debit, because reduction in depreciation means that PP&E value will increase. Okay, so the double entry for the reversal of additional or excess depreciation of 100 is this. You debit PP&E, right? Debit PP&E 100 and credit whose P&L? Subsidiary P&L, because subsidiary is the one who has recorded the additional depreciation of 100, because the buyer is the subsidiary. Subsidiary retained earnings. Where do we have the subsidiary retained earnings? It is in the net asset table of the subsidiary. Okay, subsidiary retained earnings are there in the working number 2 net asset table. And which column? Net asset table, reporting date column, because depreciation always occur after the acquisition, not at the date of acquisition. So it would have an impact on the reporting date net asset of the subsidiary. So that means in working number 2, reporting date column. How much? Credit 100. Okay, so you have to pass these two entries. Okay, first of all, unrealized profit eliminations. So shall we pass that entry first? Go to the working number 5, consolidated retained earnings. Working number 5, that is the parent's unrealized profit. Parent is the seller. That has to be eliminated. Unrealized profit, PP&E, P to S, coming from working number 13. How much? You can give the cell reference. Debit means debit, retained earnings means minus 500. Similarly, credit PP&E. Go to the face of the consolidated statement of financial position, PP&E, credit 500. Working number 30. Okay, that is the first entry. Then the second entry, reversal of excess depreciation of 100, you need to debit to PP&E. Debit PP&E. On the consolidated statement of financial position, you go and add. Debit means add 100. Again, working number 13. And credit to subsidiary retained earnings at the reporting date. So go to the working number 2 here, reversal of excess depreciation, coming from working number 13. How much? Credit to the reporting date column. You can give the cell reference 100. Okay, so nothing at the acquisition date. So that means post acquisition 100 minus 0. Post acquisition is 100. Okay, positive 100. That is how you record the transaction. Okay, this is an unrealized profit adjustment with regard to a non-current asset, PP&E item. So additional complication, in addition to the adjustment of unrealized profit, we need to make the adjustments for the reversal of additional depreciation. Right, I hope you understood about it. Right. Then moving to the adjustment number 6. What it's mentioned there, impairment tests were carried out on 31st December 2020, which concluded that consolidated goodwill was impaired by 3 million rupees And due to disappointing earnings, value of the investment in Augusta was impaired by 2.5 million rupees. Okay. First one is goodwill impairment. When there's an impairment of any asset, that particular asset value will reduce. Now, goodwill is to be calculated yet. We have not yet calculated the goodwill, but what you can do is you can keep a space to calculate the goodwill, right? Keep a space to calculate the goodwill, and you can deduct the impairment from the goodwill figure. How much is the impairment of goodwill? 3 million. 3 million means in thousands it's 3,000. Impairment of goodwill. How much? Minus 3,000. Minus 3,000 means what? Credit 3,000. Goodwill is credited by 3,000. Where you should debit? The debit entry is depending on what is the method of calculating goodwill, or what is the method of valuing your NCI at the rate of acquisition. Because we learned earlier, there are two methods to value NCI at acquisition. If you use the proportionate net asset basis to measure the NCI, and that is used to calculate the goodwill, within the goodwill figure, what is included is only the parents or the acquirer's goodwill, right? In that situation, if there's any goodwill impairment, now in this case it's 3,000, what you do is you credit entire 3,000 to the goodwill, and the entire 3,000 is getting debited to the parents' retained earnings, that is consolidated retained earnings. If you measure the NCI at proportionate net asset basis, because within the goodwill what you have is only the parents' goodwill. So entire impairment loss of goodwill is to be charged to the parent company. But at the acquisition date, if the NCI is measured by using the fair value method, which is used to calculate the goodwill, then within the goodwill figure you have both parents' goodwill as well as NCI goodwill. Actually, in this situation or in this question, adjustment number 1 explained. So the company measure the NCI at fair value, which means within the goodwill figure you have both parents' goodwill and NCI goodwill. In that situation, if the goodwill is impaired by 3,000, this impairment loss of goodwill to be allocated to both parent and the non-controlling interest. What is the percentage to the parent company? 80%, because parent has 80% holding over the subsidiary. And what is the allocation to the non-controlling interest? 20%. So the debit entry has to split. 80% of 3,000 you charge to the consolidated retained earnings, debit consolidated retained earnings. 20% of 3,000 you charge to the non-controlling interest, debit non-controlling interest. Now credit 3,000 to the goodwill, debit, you can say consolidated retained earnings, impairment of goodwill. How much? 3,000 into 80%. Okay, debit means minus. Debit means minus. 3,000 into 80%. 2,400. Debit to the consolidated retained earnings. Similarly, you can say good impairment of goodwill is getting debited to NCI. How much? 3,000 into 20%. Again, debit means minus. Debit 600. Always ensure that the double entries are passed. Credit 3,000 goodwill, debit 2,400 to consolidated retained earnings, debit 600 to non-controlling interest. So that's how you recognize the amount of the goodwill impaired, right? That is done. And also the adjustment number 6 includes one more thing. Due to the disappointing earnings, value of the investment in Augusta was impaired by 2.5 million. Not only goodwill, investment in associate is also impaired by how much? 2.5 million. So your investment, initially it had a cost of 10,000. Your investment value, what you invested, is impaired by 2,500. Very simple. You need to credit the particular investment. Okay, you need to credit the investment, saying that impairment. How much is the impairment loss? 2,500. Credit means what? Minus 2,500. And this has to be debited to the investor's P&L. That loss is incurred by the investor. Investor's 25% investment in the associate is impaired by 2,500. Credit the investment in associate, debit to the investor's P&L. That means in the balance sheet, consolidated retained earnings. You can say impairment of associate. How much? Debit means minus 2,500. Debit minus 2,500. Debit 2,500 to the consolidated retained earnings. Credit 2,500 to the investment in associate. So that is the double entry. Okay, debit and credit. Okay, so that is actually the adjustment number 6. Then it says adjustment number 7, assume all profits accrue evenly throughout the year. So the profits accrue throughout the year evenly. So why this information is given? Mainly with regard to the calculation of share of post-acquisition profits or the share of post-acquisition net asset increase of the associate. Because if you look at the group structure, associate was acquired by P, by the investor, that is the parent company, on 1st May 2020. That means during the current year, only 8 months, this associate was under the significant influence of the investor. So the post-acquisition profits of the associate is limited for how many months? 8 months. Now, if I go to the balance sheet, the equity section of the associate, that is the third column, Augusta, at the beginning or the 1st January 2020, retained earnings balance of the associate 31,800. During the year, associate made a profit of 1,200. This 1,200 is earned for how many months? 12 months, entire year, for the year ended 31st December 2020. But once you want to calculate the post-acquisition profits or the post-acquisition net asset increase of the associate out of this 12 months profit, I have to take only 8 months. You have to divide this 1,200 by 12 and multiply it by 8. Divide this by 12 and multiply it by 8. It is how much? 800. Okay. So the post-acquisition net asset increase or the post-acquisition profit is 800. So what equity accounting says is, you need to measure the investment in associate, that is working number 6, at cost plus share of post-acquisition net asset increase, or cost plus share of post-acquisition profit increase here. Then there can be adjustments like unrealized profit adjustment, there can be adjustment for the impairment, but equity accounting means cost plus share of post-acquisition net asset increase. I can take that now. So I can say share of post-acquisition net asset. NA means net asset change. How do we take? So 1,200 is the 12 months profit. So you have to take 8 months, 1st of May 2020 to 31st December 2020. This has to be multiplied by 8 upon 12, then 8 months profit into your share. Always with regard to the associate, what you take is net asset increase. What is the investor's share? Investor has acquired how much of the associate? 25%. You have to take 25%. You have to take 25%. So what is the answer? 1,200 divided by 12 multiplied by 8 into 25%. How much? 200. So the investment in associate value will increase by 200. That means debit 200 here. This is taken to the parents or the investors' retained earnings. So the investors' net asset will go up by 200. Okay, it is added to the investors' retained earnings. So consolidated retained earnings. So the double entry is debit to the investment in associate 200 and credit entry goes to the consolidated retained earnings. That is what is happening in the equity accounting. Okay. You can say share of post acquisition net asset, share of post acquisition net asset change of associate. How much? So the same figure, 200. Right. So now I have made the adjustments for all the, or I have recorded the double entries for all the adjustments in the question, right? With that. Now we need to finish the working and complete the consolidated statement of financial position, because all workings, adjustments have been looked at and entries have been passed. Right, starting from the working number 1. Working number 1, group structure, there's nothing to do, it's done. Working number 2, net asset table. So what you need to do is you have to take the total of acquisition date column. How much? 29,000, that is net assets of the subsidiary at acquisition. Then net asset of the subsidiary at reporting date, 33,600. Post acquisition, that is actually the change in the net asset from acquisition date to the reporting date. So the acquisition net asset of the subsidiary 29,000 after making the consolidation adjustments even. Reporting date net assets are 33,600. So the difference between 33,600 and 29,000 is the post acquisition net asset of the subsidiary. Now this net asset table is one of the important working in consolidation, because out of the net asset working only we take the figures to complete working number 3 goodwill, working number 4 non-controlling interest, and working number 5 consolidated retained earnings. Let's see how do we use that. Now with regard to the goodwill calculation, working number 3, parent has acquired 80% of the subsidiary, paid consideration in 2 forms, cash and deferred. So the total value is 37,000. That is 80% acquisition of the parent company. Consideration is in total 37,000. Then 20% of NCI is having a fair value of 7,000 at the date of acquisition. What we do is we take the total of these two. What is the total? 37,000 plus 7,000, 44,000. Then to calculate the goodwill, what we do is from this we deduct fair value of net asset of subsidiary at acquisition. Fair value of net asset of subsidiary at acquisition. Where do we have that information? Fair value of subsidiary's net asset at acquisition. Working number 2, net asset table of subsidiary, acquisition date column. The first column is important for me to calculate the what? Goodwill. Right, this 29,000 you deduct here, equal to, you can give the cell reference, 29,000 you deduct, right. Once you deduct 29,000, you get the goodwill of the subsidiary at acquisition, goodwill at acquisition. How much? 44,000 minus 29,000, 15,000 goodwill at acquisition. Then there's a goodwill impairment subsequently, 3,000. So that has to be deducted from the goodwill at acquisition. Then I can say that reporting date goodwill figure is how much? 15,000 minus 3,000, which is 12,000. So this is the goodwill on the consolidated balance sheet at the reporting date. I can take this to the face of the consolidated statement of financial position. Here goodwill of subsidiary coming from working number 3, I can give the cell reference. How much? 12,000, right. That is taken to the face of the consolidated statement of financial position. Then to complete working number 4 non-controlling interest and working number 5 consolidated retained earnings, in this net asset table what is important is this post acquisition net asset change. Now acquisition date to the reporting date, net assets of the subsidiary has been increased by how much? 4,600. My question to you is, to whom this net asset increase of the subsidiary belongs to? Subsidiary net assets increase belongs to the subsidiary's shareholders, right? Who are the shareholders of the subsidiary? Parent company is having 80% and non-controlling interest is having 20%. So which means out of this 4,600, 80% belongs to the parent, 20% belongs to the non-controlling interest. What is belongs to the parent, you take to the consolidated retained earnings, 80%. What is belongs to non-controlling interest, you take to the non-controlling interest. What is belongs to the parent, we'll take to the consolidated retained earnings. Working number 5, I would say S, post-acquisition, subsidiary post-acquisition. How much? 4,600 into, what is the percentage? 80%. Okay, so 4,600 into 80%. So that is this 4,600 means post-acquisition net assets of the subsidiary. You can do the computation, you can give the cell reference itself, 4,600 into 80%. 3,680, that belongs to the parent. Similarly, with regard to subsidiary post-acquisition, 20% belongs to the NCI. Again, post-acquisition net assets are 4,600, that is taken from working number 2 net asset table, post-acquisition column, 4,600 into 20%. So I can give the cell reference 4,600 into 20%. That comes to 920. Okay. So again, you see how important this net asset table, right? To calculate the goodwill, to calculate the NCI, to calculate the consolidated retained earnings. This is important. So this is one of the critical working in consolidated balance sheet question. Okay, right. Then we have actually taken the equity accounted value of the working number 6, investment in associate. And the other workings what we have done are completed. Actually, those are the workings that we have done to take the numbers to the figures reported on the consolidated statement of financial position, as well as to recognize the plus or minuses, or the debit or the credit entries with regard to working number 3, 4, 5 and 6. So working number 7, deferred consideration, there's nothing to complete, it's done. Working number 8, value depreciation, completed. Working number 9, value amortization, completed. Unrealized profit, inventory, parent to subsidiary, completed. Unrealized profit inventory, parent to associate, completed. Intercompany balances, we have passed the entries with regard to the cash in transit and eliminated the intercompany balances between the parent and subsidiary. Then the unrealized profit adjustment with regard to property, plant and equipment between parent and subsidiary is adjusted. So all the adjustments have been done. Now what we can do is we can actually take the final value of non-controlling interest. How much is the value of the non-controlling interest? 7,000 minus 600 plus 920. How much? 7,320. We can take that to the face of the consolidated statement of financial position. Can take it. How much? 7,320 coming from working number 4 under the equity section of the consolidated statement of financial position. Similarly, I can complete working number 5. Right, I can complete working number 5. How much is the total? 32,155. So after making all the consolidated adjustment, so the value is 32,155. So that also I can take to the face of the consolidated statement of financial position under the equity section, working number 5, consolidated retained earnings, 32,155. Then similarly, I can close the working number 6 as well, investment in associate. Investment in associate, 10,000 minus 225 minus 2,500 plus 200, 7,475. This has to be taken as a non-current asset to the consolidated statement of financial position. I kept a space for that. Investment in associate, working number 6, give the cell reference, 7,475. Right, so all the workings have been completed and taken the numbers to the face of the consolidated statement of financial position. Now I need to take the additions of the other balances. So PP&E 40,000 plus 31,000 plus 4,000 minus 1,000 minus 500 plus 100, 73,600. Intangible assets 7,500 plus 3,000 minus 500. It is how much? 10,000. Okay. Then goodwill 12,000, investment in associate 7,475. Moving to the current assets inventory, you need to take the addition 11,200 plus 8,400 minus 600. So 19,000 is the inventory balance at the consolidated statement of financial position. Trade receivable 7,400 plus 5,300 minus 900 minus 1,300, 10,500. Then the bank balance is 3,400. Cash in transit we have already taken 900. Then I can take the total value of the assets. What is the total value of the assets? Non-current assets and current assets total 136,875. Okay. Then equity shares, share capital, only parents share capital appears on the face of the consolidated statement of financial position. Then we have taken the parents retained earnings, consolidated retained earnings from working number 5, 32,155. Non-controlling interest 7,320 from working number 4 we have taken. Non-current liabilities line by line addition 15,000 plus 8,000, total is 23,000. Current liabilities, there's a bank overdraft 2,500. Trade payable 11,600 plus 6,200 minus 1,300, intercompany elimination. Then deferred consideration that has to be paid on the next day, year end is 31st December 2020, this has to be paid on 1st January 2021. So how much is the balance? 5,000 plus 400. Right, we have taken the figures for the equity and the liability balances. So now I can take the total equity plus the liabilities. Once we add everything together, we get 136,875. that is tallied with the total asset value. Right, so this is a full question of the consolidated statement of financial position by taking all the possible adjustments which can be, they are in a basic group question where parent is having a subsidiary, and in this case parent is having, or investor is having an associate as well. With this we have completed the illustration number 2.